A pleasant day to everyone. For today's lesson, we're going to talk about the working capital and the source of short-term and long-term capital. In the end of this lesson, the student will understand working and net working capital. The student can also identify the sources and uses of long-term and short-term funds, and also they can differentiate all the suppliers, credit such as banks, lending companies, pawn shop, and etc. And also, student can differentiate the sources of short-term and long-term financing capital and identify the sources of short-term and long-term financing capital. First, let's talk about working capital. Working capital is an asset of the companies through their investment, such as the current assets, like for example, the cash, the accounts receivables, and even the inventory. Now, for us to understood more how the working capital being computed, we have here the current asset and also the current liability. First, let's discuss about the composition or the examples of our current assets. So, the current assets are those assets which are used or utilized within the period of 1 year are known as current assets. They are also known as a short-term assets. Current assets include cash and cash equivalents, account receivables, inventory, marketable securities, prepayments, and other liquid assets of the company. Current asset also considered as a liquid asset. Why? Is it because this kind of asset can be converted easily into cash in a short time period of time. So like for example, we have here the inventory. So once we talk about inventory, these are the numbers of our supplies. Inventory can be sold easily for a cash within 12 months. The company management as well as the other stakeholders like investors, creditors, lenders, and etc. are seriously considering this component to confirm whether they can get their invested money. Now, in terms of our current assets, like what I've said kanina, these are the component of the current asset, which are the cash and cash equivalent, the account receivable, inventory, prepaid expenses, investment, the note receivables, and also the deferred income taxes. So once we talk about cash and cash equivalent, this is a kind of cash or a hard cash. Example, these are the coin and currency that the company owns. This include cash at the bank, the petty cash balance, and other deposit. So once we talk about cash equivalents, these are the investment that is closely related to cash and can be converted into cash easily. And also in our current asset, we have the accounts receivable. So once we talk about account receivable, these are the goods that are already sold on credit by our customer. So usually si customer, they purchase goods or services to us na hindi pa sila nagbabayad on time. So we give them terms that they can pay, like for example 30, 60, or 90 days. So in here, the bad debt will be subtracted from the total receivable accounts and be transferred to profit and loss account. And also, we have the inventory. So these are the merchandise that the companies buy to sell its customers for a profit by changing the shape or without changing. So we have here the raw materials, the finished goods, the work in process, etc., and the common examples of inventory. A part of current asset, we also have the prepaid expense. So once we talk about prepaid expense, these are the paid before the transactions are made. So like for example, we have the insurance. So the insurance are the very good example in terms of the prepaid expense. And also we have the investment. When we talk about investments, these are the short term in nature and expected to be sold in the current period. So investment and stocks are one of the good example. And another thing, we also have the notes receivables. In note receivable, this is a written promise to receive a specific amount of cash from another party on future dates. This notes matures within a year or a current period. And for the last, we have the deferred income taxes. So when the company overpay taxes, then its normal calculation is called deferred tax. This tax can be refunded or to adjusted with the future tax. Now, let's talk about the current liabilities. Current liability is a financial obligation that the company needs to pay within a year of incurring it. that fulfill this obligation using the current assets. Now, we also have the types of the current liability. First is we have the accounts payable. Here, the company paid the creditors in a short term. We also have the notes payable. It might be interest bearing or non-interest bearing. First, in our current liabilities, we have the accounts payable. So these are the payment that we need to do because we own money from a certain suppliers. And also, we have the accrued expenses. So these are the bills which are due to a third party but not payable, for instance, wages payable. And also, we have the accrued interest. So, si company, ayan, meron silang mga iba't ibang interest na kailangan nilang bayaran because they have some loans or some finances. And also, we have the bank account overdraft. So, these are the short-term advances that are outlined by the bank for the purpose of overdrafts. And also, we have the note payable or bank loans. So, these are the existing principal part of a long-term loan. And also, we have the dividends payable. They are the dividends stated by the enterprise that are due to be paid to the stakeholder or shareholder. And also, part of our current liabilities are the income taxes payable. So these are the income tax, is a kind of tax that is owed to the government that is due to be paid. And for the last, we have the wages. So these are the wages that we need to pay our employees. Now, how to get the working capital? So like what I've said kanina, we need to deduct or less all the current liabilities that we have to our current asset. So like for example, we have a total of $1.75 million in asset and we owe or we have the liability of $550,000. So just we need to subtract it and we will get the $1.2 million and that will be our working capital. Next, we also have the different types of working capital. So we have the gross working capital, the net working capital, the permanent or the fixed working capital. And for the last is the temporary or variable working capital. So let's discuss it or one by one. First, the gross working capital. So by here, these are the current assets of the company balance sheet represent the gross working capital of the company. Gross working capital is the summation of the company's current asset. Ibig sabihin, ito po yung kabuuang asset ni company. So these are the assets that are again converted or convertible to cash within a year or less. Gross working capital includes assets such as, again, cash, accounts receivable, inventory, short-term investments, and marketable security. Next is we have the net working capital. Net working capital is called simply as working capital. It is calculated as current asset minus or less current liabilities. Again, net working capital is the aggregate amount of all current assets and the current liability. It is used to measure the short-term liquidity of a business and can also use to obtain a general impression of the ability of the company's management to utilize assets in efficient manners. Next is we have the permanent or fixed working capital. It is the level below which the net working capital has never gone. It is further divided into regular WC and reverse WC or the working capital. This is the part of working capital which is permanently locked up in the current asset to carry out the business smoothly. The minimum amount of current asset which is required to conduct the business smoothly during the year is called permanent working capital. And for the last, we have the temporary or variable working capital. So in here, net working capital less permanent working capital. It is further divided into seasonal working capital and special working capital. It is the excess amount of a business needs over and above its permanent counterpart. It is related to the volume of production in a business. Since sales and production fluctuate throughout the year, working capital requirements may also vary. So again, when we talk about working capital management, this is how the business or the administration of the company work or control the working capital. The main job of administration is to balance the primary objectives of working capital management is definitely to achieve between profitability and the rest permanent working capital. The minimum level of current asset requires with the firm to carry on its business operations given its production capacity or relevant sales range. Next, we also have some sources of short-term and long-term financing capital. So let's start with the short-term. In short term, we have here the bank credit, the trade credit, the installment credit, consumer credit or customer's advance, and also we have the accounts receivable financing. Let's talk about the bank credit. Our banks have definitely an important role as suppliers of short-term working capital requirements of a business concern. So they are offering different kinds of financial services so that the businesses can have their own capital. First is what we have, the cash credits. This is the most popular way of providing financial assistance is through cash credit. For obtaining cash credit, a company has to furnish a security of tangible assets, like for example, the stack of finished goods or semi-finished goods or raw materials and can borrow up to agreed amount. The businesses are required to pay interest on the actual amount utilized. It is also called as the secured credit. If the cash credit is not backed by any security, it is known as clean cash credit, under which the borrower gives promissory note and signed by the two sureties. Borrowers should bring the account to credit at least once in a year. And also, we have the so-called line of credit. The bank agrees to allow the company to borrow up a certain amount. The company has to keep deposit, like for example, 20% with the bank for securing a line of credit. And also, we have the discounting of bills. The companies can get financial assistance by discounting their bills of exchange under the promissory notes and handbills from banks. These documents are discounted by the banks at a price lower than their face value. Genuine trade bills are the most used to the traders, acceptors, and also the commercial banks, but the bill market has to be developed. And also we have the overdraft. Banks also provide facilities of overdraft under which the customers can draw more money than they have actually deposited. Under this arrangement, the customers are charged interest on the amount actually overdrawn and not on the limit or what they call sanction. The overdraft is allowed from 1 week to 1 month to overcome the occasional shortage of funds sufficiently in our country. Next is the term loans. In term loans means these are the advance granted for a period of more than a year or so. Under this, the borrowers receives the loan in a lump sum and is required to pay interest on fixed rate till the repayment of the loan. Borrower can return the loan in installments or in lump sum. Interest is paid on the reduced balance. The commercial banks have also started granting credit to small-scale industry. Small-scale units were looked upon as risky and the bank were reluctant in advancing money to them. But now, preference is given to small-scale industry in granting bank credit. Next is we have the trade credit. This is when the company sells goods, it allows credit to its customer. Similarly, it gets credit from its supplier, known as the trade credit. According to Howard and others, trade credit may be defined as the credit extended by the sellers to buyers at all levels of production and distribution processes down to the retailers. It does include consumer credit on installment. It rises due to difficult transfer of goods and is unsecured. The usual duration of such credit is 30 to 90 days. It is granted to the buyer an open account without any security. Example on the goodwill and creditworthiness of the buyer. Trade credit facilities the purchase of goods without immediate payment. No interest is charged on the trade credit. Only the price is a little higher than the cash price. The period of trade credit depends upon the financial resources of the suppliers, nature of product, location of the customers, traditional trade, degree of competition in the market, and the eagerness of the supplier to sell his stocks. Next is what we have, the installment In installment credit, this is known as consumer credit. It is usually allowed by retailer for selling consumer durable like television, sets or fans, radios, refrigerators, washing machines, scooter, motorcycle, cars, etc. Some portion of the cost price of the asset is paid at the time of delivery, and the balance is paid in numbers of installment along with interest. Sometimes installment credit is granted by financial companies or commercial banks, which have a special arrangement with the suppliers. Machinery or equipment may also be owned on hire purchase basis. Under this system, the purchasers becomes the owner only when all the installments are paid. And also, we have the consumer credit or customers advance. Many times, the suppliers or manufacturers of goods insist on advance by customers along with orders. Such advances represent part of the price and carry no interest. A manufacturer can meet his short-term needs at least partly. Through customer advance, the period of such credit depends upon the time taken to deliver the goods. The availability of this credit depend on the degree of competition in the market, customs of the trade, and usage and reputation of the suppliers. And for the last, we have the account receivable financing. Under this arrangement, the account receivable of business concern are brought by the financing company or money may be advanced on security of accounts receivable. Normally, this is 60% of value of accounts receivable pledge is advanced by the finance companies. If there are any bad debt, it is to be borne by the business concern itself. This account receivable is a right to property and a right to collect the amount from the client. This method of financing is very popular in our. Next is we have the long-term working capital or the sources of long-term capital. Sources of long-term finances are those sources from where the funds are raised for a longer period of time. Usually, more than a year, long-term financing is required for modernization, expansion, diversification, and development of a business operation. Generally, the companies resort to the sources of long-term finance when they have inadequate cash balance and need capital to carry out its operation for a longer period of time. Now, we have here the objectives of long-term financing. First, once the company need to have a new set of equipment. Obviously, equipments are costly. So the businesses, if ever they don't have money yet or they don't have the budget for that, they really looking for the long-term financing. Second is to finance the permanent part of the working capital. So once we talk about permanent part, ito po yung mga raw materials or input na hindi po dapat mawala sa ating production. And third, to enhance the cash flow in the firm. Somehow, if we cannot balance our liabilities and asset, we need to reinvest again. Okay, so that our cash flow will be smooth. And if the stakeholder will see it, automatically they will be confident to reinvest again and to invest in R&D operation. R&D meaning to say research and development. We all know that research and developments are expensive. Why? Because in here we have the so-called trial and error. So time to time, kapag po hindi nagtutugma yung idea nung inventors or nung mga expert, yeah, they really need to redevelop again. Next, to construct a new building. So in here, so dahil nga ito ay building, it really takes a lot of millions of pesos. And to develop a new product. A new product, we have a lot to consider: the packaging, the new suppliers, the new materials that we need to do or that we need to have, and also numbers of employees. And to design marketing strategies or increase facilities. We all know also that the marketing activities really need to have a lot of money or investment so that we will be known to the market. And to expand business operation. So, nagkakaroon tayo ng mga different branches. So, once we do expansion and once we ask for financing of it, we need to make sure na itong expansion na ito ay kikita si business. Now, these are the internal and also external sources of our long-term working capital. Una na po rito is the return earning. So once we talk about retained earning, these are the income from our investors. So ibig sabihin, yung income nila o yung kinikita nila sa pag-invest sa atin, i-retain lang nila or i-reinvest lang ni investors. And also, we have the external sources. So in our external sources, we have here the equity capital. So once we talk about equity capital, these are the fund paid into business by investors in exchange for a common or prepared stocks. So these are also represent the core funding of a business to which debt fundings may be also added. And for the next one, we have the preference capital. This is the portion of capital which is raised through the issue of the preference shares. This is the hybrid form of financing that has certain characteristics of equity, certain attributes of debentures. Next is we have the term loan. A term loan is a definite loan from the bank for a specific amount that has a specified repayment schedule and fixed or floating interest rate. And for the last, we have the debentures. Debenture is a marketable security. This is a type of investment issued by the business or any organization to raise money for long-term activities and growth. It is a form of debt capital, so it is accounted for a debt on the balance sheet of the issuing companies. Thank you so much for listening.